We're joined today by Hussein Allidina, Managing Director and Head of Commodities at TD Asset Management, and Fred Wang, Senior Portfolio Manager and Head of Asset Allocation and Managed Investments at TD Wealth Investment Offices. Both here to discuss how alternative investments are being used in ultra-high net worth portfolios, from diversification and income to managing risk in a more complex market environment. And we are in a more complex market environment, gentlemen. Nice to see you both.
Thanks for having us.
Fred, I want to start with you if I can. And again, a lot of this information will depend on what the client's objectives are and what they're trying to do. But these are some of the options that are available to them. And after a few years of quite strong equity market performance and markets near an all-time high, how are you looking at diversifying your clients' portfolios with alternatives today?
Very, very relevant question, Kim. Definitely, market is high and it's makes sense to be concerned a little bit. So there are a couple of options we normally talk about going forward with the client. Number one is actually hedge fund. We think although the market is high, the correlation among individual stocks is actually near a historical low. So in English, it means stocks are not moving in tandem as much. So if you are a skilled hedge fund manager who normally bet on winners and sell the losers, and your profit is actually the performance difference between the two, that payoff is much larger going forward because they're not just moving in tandem. So for us, we're very constructive in terms of moving into long-short equity market neutral type of hedge fund strategies. And the other driver is really AI we talk about. It's revolutionizing every industry. So for big change, normally it creates a lot more winners and a lot more losers. So from a picking standpoint, your opportunity set is much larger. The second option we can think about is private equity. Although the public market is very expensive, many of us is aware, but the private transactions in the private equity market, we track all the transactions and calculate the aggregate average, is actually only modestly higher than historical average. So I think that related to higher interest rate for the couple of years in the past, it's behind us. But the other side is the private equity managers, they can stick to their discipline. So they're not paying overly expensive price for quality assets. Moving into 2026, we see corporate M&A activities coming back. We see better IPO market going forward. So private equity can have better exit options. The third is really like a long-term playbook we have in our portfolios, very strategic. It's commodities, what Hussein was going to talk about today.
Yeah.
And it's, for total portfolio, it creates, an inflation hedge. It diversifies your portfolio because it has low correlation with equity and bonds. And there are a lot of opportunities in this very geopolitical heavy, kind of risky environment. I think we can talk about it in more details.
Yeah, we'll get to Hussein in a moment. I promise. Those
Thank you.
Much detail on commodities. You're welcome. Before we get there, though, I did want to ask you, for clients who have income as a priority in terms of their outlook in the near term, or maybe in the long term too, what are the kinds of tools or assets you look at in terms of how you structure the portfolios in a lower interest rate environment?
Very fair. If we build an income portfolio this year, we cannot rely on corporate bond anymore. You have to do a little bit extra things to diversify your source of income. Number one come to mind as an option is real assets. Real estate infrastructure, so these are assets with contractual cash flows. It provides that regular income in your portfolio. The other thing we like about real assets is actually replacement cost. It's actually very expensive to recreate these underlying assets in today's environment. For example, construction cost post-COVID is at least 50% higher in our own country. And that's just one part of the world. It's very, very widespread. The other option is option overlay strategies within equity portfolios. we see a huge volume spike in retail participation in the equity option market. Retail investors just trading more, and they are utilizing the shorter expiry date options. I think we see that in our own part of our own business. And for equity managers who are good stock pickers, they have entry and exit levels. If you can use option to help you implement your investment discipline, it actually helps your own portfolio management activity, but also you're getting paid. So that additional income from selling options is a good complement to your existing portfolios. The third answer I'm going to surprise you is actually private equity again. We're not talking about general buyout. You have to kind of start from your zero, start deploying capital today. We're talking about private equity secondaries. So private equities, similar to public equity, you can actually acquire seasoned private equity stake from other investors. The beauty of that is if you buy a company, improve the operation for a couple of years and exit, you're looking at least 5-year time horizon. But if you're buying these private equity stake in year 4, you're closer to that exit point, and naturally you will have liquidity out of these exits. So a lot of the strategies we're looking at, they actually surprise you, paying high single digit to low teens in terms of distribution. So if you're running a foundation, right, there's a distribution requirement, you can rely on these strategies to drive organic income from your portfolio today. So we're very excited about the environment we're heading into.
Interesting. Lots of optionality there. If you know where to look, I guess that's the key. Hussein, Fred was talking about commodities as an inflation hedge in terms of the portfolio moving forward. But question for you is, I think, and correct me if I'm wrong, 15% overall gain in commodities in 2025, average of 10% annualized since COVID. There's been a whole lot of upside. Is there more?
I think there is. So I think if you look at where we are in the commodity cycle, we have to, so notwithstanding the increases in prices we've seen, we're still not attracting capital to the supply side. The supply side has been neglected for the better part of the last 10 years, 12 years into COVID, and we still consume these commodities, and increasingly our consumption of those commodities, the second derivative is getting stronger, partially because of AI, but we haven't yet deployed capital into the ground to find incremental copper, aluminium, gold, et cetera. And it takes a long time for that supply to come to market once you start investing. We haven't started investing yet, and for that reason, we think that prices will continue to move higher in an effort to limit demand growth and to incent that capital away from other areas into the commodity space.
Right.
So I think still very, very early innings of this cycle.
It's interesting, I know we've talked about this, is that, AI pulls in a lot of capital, but ultimately you need the power to drive it. And so it's kind of this cyclical thing where if you take it over here, you're not getting it there, which causes this to go even higher.
Commodities tend to go through these very, very long cycles, and you're absolutely right. Unlike the cycle that started in the early 2000s or the cycle that started in the early 80s, today capital is going into a space that is very, very commodity intensive. In the late 90s, when I had a full head of hair, we had capital going into the internet stocks, pets.com, et cetera. They weren't very commodity intensive. Today, capital is going into data centers, hyperscalers that require a tremendous amount of copper, will require a tremendous amount of natural gas or uranium or power, however you're going to source it. But we're not investing in the upstream for the commodities, and we haven't invested in the upstream for commodities since arguably 2010, 2011 because of what commodity prices have been doing. And this is why I think that it's very unique to the investment phase of the commodity cycle, but what we're seeing right now is not unique relative to prior investment cycles.
Yep.
It takes some time for the market to kill that recency bias about how challenged commodities have been. We're starting to see that for sure in the inbound interest that we're getting from both retail and institutional, but I think it's still early innings.
So constructive, safe to say,
Very
on
constructive.
commodities. But what would you say when you look ahead to next year? What are the biggest risks in terms of upside and downside?
So 2026, I think your biggest sort of upside comes from this sort of reflation cycle that we're seeing. So the fiscal impulse, the monetary impulse is going to drive growth higher. that stokes commodity demand. There's a lot of very specific, even though the GDP number may not be as high as it was in, I don't know, 2006, a lot of that GDP, again, is being spent on things that are very commodity intensive. Obviously AI, but also infra, military, that's all very, very commodity intensive. So that is, I think, what the upside stems from. Of course, if we have a supply disruption because of the geopolitics, which seem like they're not going anywhere, whether it's Venezuela, Iran, Ukraine, that would present upside. We're not rooting for that. That's not part of our core thesis on why we like commodities, but we recognize if that happens, there is upside. Weaker US dollar, concerns over inflation would invite more participation in the commodity space because of the inflation properties that commodities afford. The piece that I think I'm most worried about, Kim, and this is a constant, is growth. If growth disappoints, I've been maybe more bearish growth than I should have been over the course of the last couple of years, but it's something that I always worry about. When growth disappoints, the supply side doesn't matter. If we're not consuming oil because GDP is not there to justify the consumption of oil, the supply constraint doesn't matter. Today, why I'm more constructive, it looks like not just in the US, but globally, we're trying to stoke growth as much as we possibly can. That might be one of the ways that we get out of these elevated levels of debt and deficit. Sort of all hands on deck to drive growth. That is my concern if that doesn't work, but all the indicators that we're looking at right now point to better growth.
All right, well, great rundown of all the options, and appreciate both your time. Hussein, Fred, thanks so much.
Thanks for having us.